What is intrinsic value? How can you use this to your advantage? Value before expiration at time. So when you're looking at this chart, you're looking at a time and a strike price. So you're seeing the value of a current position, and you're also seeing the ending of the value of the price. So that's what the top where it says option value, that's going to be the price. And then when you have the asset spot price, that's going to be as it goes on, whether the intrinsic value raises or lowers. We have the intrinsic value and time value. Stock price equals $56, and the price is a $50 strike call option. So it's an $8. So if you're looking at this, basically what it's saying is that you're paying an $6 intrinsic value, and the current stock price you can is at $56. So you're paying a time value of $2 and you're paying an intrinsic value of $6. So that makes your option premium or price $8. So if you're able to buy the stock at $50, why would you pay $58 to be able to buy 100 shares? So that's what you're paying for at the time when you buy an option. You're buying this strike price for a later expiration and expecting the stock option or the stock price to move up over the $50. Well, it needs to move over $50 plus the $8. So if you were to buy the shares, it would cost you $500. At this point, it's costing you $508. But you're paying an $8 premium for the intrinsic value, that there's a certain amount of time frame that the underlying value or the underlying asset may move up over that price. Basically, when you're looking at intrinsic value, what that means for you is you're buying an option, you're buying a position in a stock, believing that it's going to move up in a certain amount of time. And when you buy this call option, believing that something's going to move up in a set period of time, you are now giving yourself a hedged position or a go-ahead position, saying that you believe that you're going to beat the other person. They're giving you an option saying, I'm going to sell it to you, thinking that the price is going to go down. And you're buying it from them, betting against them, thinking it's going to go up. So if, let's say you own 100 shares on a stock that is currently at $50, well, you own it for $500, right? And now you are looking to, or I'm sorry, 5,000, and you're looking to sell this stock to somebody else at $2.50 above where your current price is. Well, let's say that there's a 52.50 call. So that means that you can now sell a call to somebody else, which gives them the option to buy 100 shares from you. Well, if you're break even and you sell it to that person for $8 over the current price of the strike, then, or the current value of the stock, then you're now implying the implied volatility, you're implying the intrinsic value, you're implying that it's going to go up, so you're charging them a premium for that fact. Well, as it rises, you're now going to take the profit from your position that you hold, the 100 shares, and it's going to rise all the way up to that $2.50 profit of 52.50. That person can now exercise that option and they can buy your shares for $2.50. So now you make the profit there, but you've lost that intrinsic value, which is the value that you charge them for that contract. So when they exercise it, you lose that value. Now, if the value of the contract stays the same or it goes down after you sell to them, then that intrinsic value will go down, and now that option will now lose its intrinsic value because you're now seeing the price of the stock go down. So therefore it loses the idea that it can move up to a higher price. So therefore people are selling the option at a lower price and people are offering to bid at a lower price. So once someone starts to bid at a lower price and the ask goes to a lower price, the implied volatility will go down. So therefore the intrinsic value goes down, and there's no longer a reason for someone to pay you more than what the current price is, because they don't think it's going to go past that certain level. So long or the short is, you buy something and you expect it to move up. If the stock does not move and it slowly goes up maybe 1 or 2 pennies a day, and a week goes by and you've lost a week of time, then your intrinsic value is going to drastically be impacted by that. because the whole reason why intrinsic value is calculated is based off of the fact that the buyers and the sellers believe that the stock's going to move up or down in a said direction, whether it's down or up. And that is the extrinsic value and the intrinsic value. When you're looking at a contract and it's moving a certain direction, the reason why the price is reflected where it's at when let's say the stock's at $50 and you're paying 508, why would you pay $8 over the current price when you could just buy the shares? Well, it's because you're betting that the stock is going to, or the value or the asset's going to move up in stock price over your strike during that expiration. And if it goes stagnant, then you would lose the intrinsic value because there is no longer the idea that's going to move past your level at that expiration, and therefore you would lose the price. So that way, when you're selling that as well to somebody, if you sell that call option to somebody, then the intrinsic value for them would die down, and that's how you collect that premium when it doesn't go past $50. So if it ends up being at $49 by your expiration, then all that intrinsic value is gone and all of the value of the contract's gone, and therefore you collect that premium. So if you guys have any questions about that, I'll open it up for you to talk to me about it.
Can you explain that again, please? Like the intrinsic value part, like why would you pay the $8 more when you could get it for 500? The intrinsic value, does that mean like the hype of the stock? People are like interested in it and there's a bunch of hoo-ha going on around it? Is that what that is?
Yes, with the price action. So like the fact that so Tesla, it has an intrinsic value based over a 52-day or 52-week period that the asset's going to move at a certain period. Let's say it's 68%. So the implied volatility over a year is that the stock's going to move from one direction to another 68%. So therefore, your timing is based off of where do you think it's going to move up or down from that current strike price or that current stock, or sorry, that current value of the share. And I like to use 50, or I actually like to use $10. It's easier for math. So if you have a $10 strike price and the company's at $10, then in your mind you're like, well, I should only have to pay $100 a contract. But if the asset has moved $2 at a time every week for the last 10 days, then the implied volatility is going to be higher because people are believing, hey, it might keep on moving $2 more. So therefore, the ask and the bid keep getting raised and raised and raised. And that's when you see these gaps as well, when the person that's holding the contract's willing to sell it for a further gap out than the person willing to buy it, because the person willing to buy it goes, hey, this thing's ran too far and it shouldn't keep on running. So your implied volatility is basically a hidden imaginary number in the air that's saying, hey, someone else believes that this contract's going to be worth more money at the end of the expiration than the current price that it's at now. And your idea is that but when you buy it, you want to buy it when you're closest to in the money as possible. So why would you buy the right to buy a stock at $55 when it's at $50? Because your idea is that you're paying that $5 premium because you're expecting it to go up to that $55 before that expiration, and the other person's betting you that it's going to go up or stay under that position or under that price by that expiration. So that's where that value comes in, is that it's just basically gambling. It's two people betting against each other.
Oh wow! Well, how far out would you buy something like that? I mean, like for Tesla, it seems like you could buy 3, 4, 5, 6 months out, and I don't know. It was at 605 this morning. I don't know what it's at now, but it just keeps going up. I don't know, but there's nothing else out there that keeps going up like that. So,
well,
what would you base it off of? How long would you buy it out
let's
for?
go the opposite way. So let's go the opposite way. Let's look at Kroger or Microsoft or another company Kroger's a good one, or Ford, where the contracts are 10, 20, 30, 40, 50 cents, right?
Right.
And then you look out 6 months later, guess how much they are? 80, 90, 100. They're not much more, right?
Okay.
Because the implied volatility is so low that nobody expects it to move. So when you get that 5, 6, 7% move out of Ford, in one day. That's why those contracts go from 70 to 100. You gain 30% on your contracts in
Right.
one move. It's because that old implied volatility is out the window, because now they got to go, holy crap, it just moved 7 or 8 to 20% overnight. Now they're like, well, maybe it could keep going. So now the implied volatility goes up because people aren't willing to sell them anymore at the lower price. They're wanting more money. They're asking higher, and the bids are going up.
Right. See, because I remember Ford was like at $6 and stagnant, super stagnant. Like
Yeah, so if you
nobody
bought
even looked
$9,
at
you
it.
could have bought $9 strikes for a penny because
A
nobody thought they were going to
penny.
move, and then you would have sold them for $90 a piece. A couple months later.
Wow. Right.
And can I chime in? Dude, great way to break it down. I like the way you break it down because this is a very confusing topic for a lot of people.
Watch the background noise moving around.
Sorry about that. I got my hearing aids in, so like they're Bluetooth to me. So great job breaking it down. One thing you guys gotta realize about intrinsic value. Number one, you should always know how to especially for stuff like finding the value of stuff. You should know how it's essentially done, right? So find the intrinsic value of any stock, right? You take the stock price and the option strike price, and then you minus the strike price, and then you with the option strike price that you're looking at getting in, and then you times it by the number of options that you plan on getting. That will give you your intrinsic value, right?
Wait,
So
say that
strike
again,
price.
Mickey?
Yeah. So you take your stock price, like what the
Yes.
stock is currently trading at, and you take
Okay,
the
say it's
options.
$10.
Yep, let's say it's $10, and you minus it by this option strike price that you're looking at getting into. So let's say $5, right? So that gives me $5, right? I plan on buying, let's say, 10 of those, right? My intrinsic value is $50, right? For that, right? And then the thing you got to realize is options that aren't in the money means that the strike price is greater than the current share price, right? And it has no intrinsic value and is only trading only for time value at that time and the potential that the stock price could increase. So like traders usually use intrinsic value are the traders who are like the ones who buy like weeks and months out, and then they buy in the money because they actually have intrinsic value. Am I pretty
So
correct
if
on
it's
that?
out of the
Taylor?
money, it doesn't have any intrinsic value.
So it's got value, right? But its value is based off the potential that the stock price could increase and drive the option higher. But it has no intrinsic value if it's out the money. No.
I do have a question though.
Yeah, go Blake.
Would intrinsic value would it kind of be like hype, like kind of like what a hype stock is? Where like it generates hype for like the potential that it's gonna get big. Would that be kind of similar to compare or no?
It would give you this sense of relativity. So every option has intrinsic value. So no matter what the stock is, no matter what the price is, they all have an intrinsic value. It's whether the intrinsic value is higher or lower is based off of the volatility of the stock. So if it's a low volatility stock, you have a low intrinsic value. If you have a high volatility stock, then you have a high intrinsic value. So you can charge a higher premium for the call option because people believe it could go up. But it's when you hear volatility is to the upside and to the downside. It doesn't have a direction in particular.
That's what makes it risky, right? That's where the risk is.
Yes, the risk equals the reward. If there wasn't any risk, there wouldn't be a reward. That's why when you buy a Ford call, you might make $5 a contract over a week. And with Tesla, you lose $1,000 or make $1,000 in 5 minutes.
Does build up to earnings like news? I guess news would make the volatility rise on the upside, and then bad news would make it drop on the low side, right? Basically. So if a stock comes out and they're say a farm stock or whatever, and they come out and then they get shut down by the FDA because they can't do their whatever testing. That's volatility to the downside. Is that right?
Well, the volatility is already in place before the news has happened. So let's say
Oh.
that the news comes out and says, hey, this stock has been sitting in consolidation, hasn't moved between $6 and $7 for a year. And then all of a sudden they say Ford is coming out with the new engine for electric vehicles that's going to take them to the moon in a day, and then the stock goes from
Right.
$7.50 to $12. Well, now the implied volatility and the intrinsic value is going to go way up because there's more hype to the stock. So the whole point of finding things in a consolidation period is you're trying to find something that is before that volatility has hit, and you're putting together the catalyst, the news, the situations to be able to understand that there might be a catalyst that'll move the stock in a certain direction, whether it's up or down.